Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's very favoritist podcast on life insurance.
That's right. And life insurance reservoirs.
And life insurance minutia.
Oh boy.
Actually,
if you love life insurance minutia.
Have we got one for you today?
Everyone just turned it off.
We always we try to make it sound way less approachable than it really will be, because that kind of gets the other people gone, and then the real fans, they stick around.
Yep, that's right. We are talking about whole life. We should have said that at the very beginning.
We are, yes, because whole life insurance.
We
people
know
like
that
when we do that.
That's what I'm saying. We look at statistics and we see when we talk about whole life, we get a lot of people. So, yep. We are talking about whole life.
We are specifically about whole life dividends and investment performance at the insurance company and what drives all that, especially related to what's going on right now. And here's the thing. So you can fighting the urge to say Google, because let's be honest, no one does that anymore. But you could go out searching.
Sure they do, and then it just tells you the answer at the time.
Well, okay, fine.
It just steals information from people like us and then shows it to everyone right there. So they don't need to come to our website. I'm not bitter about it. I'm just,
I might have committed that offense myself a few times.
Let's not talk about it.
So when you research the subject of whole life insurance dividends, because you're trying to understand what is going to make the dividend go up, down, or stay the same, you're probably going to find a very simplified answer that tells you interest rates go up, dividends go up, interest rates go down, dividends go down.
Yep. And it's not quite that simple.
And if we wanted to record a 2-minute podcast, that would be the answer, and we could wrap this thing up and be done for today.
Well, yeah, the full 2 minutes would be, insurance companies buy bonds. So when interest rates go up, dividend rates go up, blah, 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 blah. And that's about, that's the majority of what you'll find online.
Yep. But this is the Insurance Pro Blog Podcast, and that's not good enough. So
nope.
Now we have to get into the nitty gritty on what exactly is going on, what drives it to go in the direction that it does, and what exactly is the insurance industry doing in the face of everything else that's going on to strategize around this.
Yep.
Because yes, higher interest rates are good, but what happens if they go back down?
Yep. And
what is the industry doing to capitalize on good fortune when it comes, but plan for the fact that times may not always be as conducive to what you want? That's the majority of today's discussion.
Yeah. So we're going to start with the $9.2 billion question, right?
Sure. What is that $9.2 billion question?
Well, sir, that's actually the announced dividend payout for the quiet company for 2026.
That's a lot of money.
That's a lot of money. It's about $1 billion more than in 2025 for that particular company. And I guess notable, with a caveat, the largest 3-year dividend increase in the company's history over over 150 years.
Mm-hmm.
Now they're also coming from the lowest point. So that's kind of interesting.
That helps.
I can't say definitively that they're coming from their absolute lowest point, but in recent history, when you're at the bottom, it's a lot easier to come back up.
So Northwestern Mutual is approaching $10 billion of annual dividend payouts.
Right.
Across all of its many, many policyholders.
Yes. I was going to say, please don't infer anything by that number. Like listeners. Because
it's just a big number. That's what it is. But they're a big company.
Yep. Very big.
It's
yes, we had MassMutual
coming in
this year at $2.9 billion, Guardian at $1.7, New York Life at $2.78 billion. So
also a lot of money.
Yeah.
So
I mean, what's $1 billion between friends, really?
Right. What we're seeing now with interest rates higher is insurance companies increasing dividend scales is the technical term, which means the relativeness of the dividend is going up.
Right.
So to elaborate just slightly on that, so it's not so technical and obscure to people, per dollar of cash value that you have, the dollar of dividend that you're getting, or rather the cents of dividend that you're getting, is increasing at a rate faster than the cash balance itself.
Right.
So there's a relative increase, a higher yield, in essence, that is being achieved, which, broadly speaking, is driven by higher interest rates. Yes, that is true.
Mm-hmm. But it'd be kind of lazy to just stop there, right?
We want to be a little bit better about why, because if we tell you why, that gives us the ability to first understand what, if anything, is special about owning whole life insurance from a cash accumulation standpoint. And two, what might happen that makes this less attractive? Because, not everything goes the way you want it to.
Right. So that means we're going to dig into the general account, huh?
Yeah, we should speak to that for a second.
Should tell people what it is first.
It's a reservoir, as you already hinted at.
I like it.
So think of the general account as this big pile of money. Or if you want to stick with the reservoir idea,
stick with the reservoir. I like
this big bucket of water. All right. Where money flows in or water flows in every day.
Right.
People pay their premiums.
Yep.
And there's even additional money that is created because of investment activity.
Right.
But that water has to go towards certain things. It has to flow out to various places.
Right.
So the management on the behalf of the insurance company is ensuring that the water balance grows faster than the depletion of water as it is needed.
i.e. death benefits.
Yes. Or surrenders, loans.
Yeah. That's all factored in. Right.
Yep. That's what the general account is accomplishing.
Yep. But the managers of the general account are trying to make sure that the water itself actually produces value that they get paid for.
Correct.
So that they're constantly staying ahead of what's being paid out in benefits. I'm using benefits broadly because, like you said, there can be multiple things.
Now, when it comes to mutual insurance companies, when they create profits from their business activities, they return those profits, not directly, but they return those profits to their policyholders. And they do that through a dividend. So when they successfully manage the growth of cash or the level of water at a faster pace than the outflows, and they conduct business activity that's profitable, or they invest the dollars in a way that is profitable, meaning it can exceed the guarantees that they are obligating themselves to under the insurance contracts, they then take that excess money and use it to pay out the dividend.
Right.
And there are three elements that kind of drive the profitability and dividend calculation. So there is doing business. We usually refer to that internally as underwriting profits. So when you make more money issuing contracts that promise death benefits than you planned, you have underwriting profits.
Right.
And when you're in the business of predicting when people are going to die, it turns out we figured out a way to be pretty accurate about that.
Yep.
So unlike the home and auto business, it's kind of hard to lose money.
Right.
From an underwriting profit standpoint in the life insurance world. Then you have the investment side, and that is simply taking the dollars that you've collected, all those inflows and the housing of money, and you invest it. And If the rate of return exceeds what you need to have to cover the obligations you've committed yourself to, you have profits. And that actually has been the largest driver of the payment of dividends, the largest driver of profits for most insurance companies since pretty much the dawn of time.
Right. At least mutual insurance companies, right?
Yep.
Yeah.
So the ability to take those dollars and turn them into more dollars is more impactful on company profitability than simply the profits taken from underwriting.
Sure.
The third piece of this is actually an expense. It's just the operational piece of being in business.
How well
and
they manage it.
I don't mean that from the standpoint of underwriting, but I mean that from the standpoint of we got to hire people to answer the phone, or we got to print statements, or we got to
lease buildings and stuff like that. Yeah.
That's a negative adjustment to things.
Right. But important.
Yep. So that is the very simple construct, very simple mechanics. And this is a large sum of money. I want to emphasize that, because for a number of insurance companies, we're talking about an asset portfolio that is hundreds of billions of dollars in some cases, or at least tens of billions of dollars, which is large.
Yeah.
And combined, the industry holds about $9 trillion, which for comparison's sake is roughly the same amount of money that is sitting in IRAs across the United States.
Yeah.
That one's the IRA balance is kind of speculative, but somewhere between 10 and 12 trillion dollars is what it's estimated to be valued at. So $9 trillion is close-ish to what Americans hold in retirement accounts. IRAs.
Right. So that means, this is in terms of private businesses, non-governmental entities. This is like some of the largest pools of capital
in one place. Yeah.
Yep.
So it has immense assets under management, which gives it a certain amount of leverage to do things that we're going to get into in a few minutes. But first we should note, stylistically, the investment process for insurance companies has largely been comprised or concentrated in debt and style investments.
Right.
So,
often called fixed income.
Yeah. Also known as bonds. But I want to emphasize something. We say bonds, and we do mean bonds for the most part. But we don't mean bonds like those of you who logged into your Vanguard account and bought some BND today.
Right.
Nor do we mean bonds like those of you who went to Treasury Direct and bought some 10-year treasuries today.
Right.
Or went to the local bank and found out that your municipality is issuing a debt issuance. Look at me go, words. For a new park.
Right.
And you can be an investor and buy some municipal bonds.
Right.
It's a bit different. We're gonna go through that. But before we do that, the unique thing about the investment or the bond investment style or preference for insurance companies is to buy them very specifically for the income they will generate.
Right.
Which is a statement that seems silly and kind of meaningless. But if you think about the way most investors, retail and institutional in many respects, approach bond investing, they don't do it that way.
Right.
Very, very few retail investors buy bonds for the income side of it.
Right.
They tell you they do. But ultimately, all they're doing is saying, well, I'm going to get 4% on this treasury, so that's cool. That's better than I got in my money market account. So yeah, I'm just going to buy the treasuries and collect the interest.
Right.
The insurance company's buying the bond, quote unquote, with the specific intention of matching it to the contractual liability that they have created by issuing an insurance contract.
Right.
Which means they have zero desire to sell the bond if the opportunity presents itself.
Right.
Because if they sell the bond, they now no longer have the asset to back the liability.
Right.
That is...
They're just doing it for actuarial soundness, I suppose would be the... Like, does this exceed our future obligations? Yes. Okay, good. We'll buy it, and then we're just going to hold on to it.
That is a critically important thing to understand.
Right.
Regarding the investment philosophy and strategy, because it affords certain opportunities that would not exist otherwise.
Mm-hmm.
So one of the major sort of zoomed out headline pieces of why right now we're seeing dividends go up is because interest rates are going up. And what's happening is insurance companies are taking the premium they collect from policyholders, and they're taking the bonds that are expiring, and they're buying new ones at current market rates.
Yep.
Which in many cases are higher than the interest they were earning on the ones that are going away.
Right.
So there's kind of a rolling up of yield that is taking place.
And it's been taking place for the last few years, but it's now starting to impact. As we've talked about many times, it doesn't happen quickly because of exactly of what you just described. It's a I guess I would call it a dilutive process, but it's sort of a reverse dilution at this point. It's going in the other way.
Think about it if you owned a bunch of CDs. And let's say the average yield on your CDs were something like 4.5%.
Right.
And let's say that you bought those CDs every single year, which means every year moving forward, one of those older CDs is going to mature.
Right.
You're going to get your money back, and now you need to go out and buy another CD.
Right. Or decide what you're going to do with the money, one way or the other.
Yeah. So if your average rate across all your CDs is 4.5%, but you just had a CD mature, and let's say that CD rate was like 1.5%.
Right.
Well, the good news is that's gone. And now I can buy a new CD, and let's say the current rates are like 5. What's that going to do to the overall average yield for next year? It's going to make it go up. And there's two things that are going to drive it up. One, the older, lower yielding CD is gone. So that's now no longer part of the equation. And you now have replaced it with a higher earning CD, which pushes your average earning up as well.
Right.
That's what's going on inside the insurance industry as we speak. In fact, when we look at average yield across all life insurance companies, in 2023, the average yield increased by 28 basis points. In 2024, it increased by 29 basis points. So we're getting this slightly better than 0.25% increase trend each year for the insurance industry because of old bonds going away, taking that money and buying it new bonds at better rates, plus we're collecting premium and being able to buy at current rates.
Right.
That significantly helps push interest rates up. And the other cool thing about this is this kind of wind-up thing that I mentioned earlier means that it's, to your point, slow to react to current economic conditions, but it will catch up.
Yeah.
But once it spins up, there's an inertia to that stops it from just hitting the brakes if interest rates go down.
Right.
So if we see lower rates, we still have all of the benefit that we've been building up over the course of the past couple of years as rates have gone up, and there has been an opportunity to replace old bonds with higher yielding ones, plus take new money and buy higher yielding bonds.
Right.
This is exactly why we saw a dramatic drop in interest rates following 2008. But it took somewhere in the neighborhood of like 7 years before we saw dividends reach their bottom.
Right.
At whole life focused companies.
And they didn't reach it all at the same time. You're just given a general range.
Yep.
But, yeah.
Because that slow to wind up also means slow to wind down.
Wind down. Yeah.
Now, the big thing that drives additionally more opportunity for the life insurance industry, and it's easy to get kind of caught in the oversimplified understanding of interest rate policy, like the Fed sets rates. The Fed sets short-term rates that are really important for the banking industry.
Right.
And that's really all the Fed does. Market rates, bond yields, be they treasuries or corporates, are set by the market.
Right.
We had an entire podcast discussion about that a couple weeks ago. The assumption is, well, then you could just buy the bonds and do what the insurance company's doing and cut out the middleman.
Mm-hmm.
I can't tell you the number of times we have
buy
had...
term and buy bonds with the difference. See, it just rolls right off the tongue.
I can't tell you the number of times we have had financial professionals, many of them who hold a certain designation that makes them certified, write to us and ask us, why wouldn't we just sell our clients' bonds and cut out the insurance expenses?
Right.
And the answer to that we've always kind of had was the investment.
One, you're presuming that the insurance itself has no value to the person.
Well, there's that. Yes.
That's just a really big assumption.
Yeah. Yeah. The other piece is the way that insurance companies buy bonds is not the way you and I buy bonds. And I don't even mean that in the context of something we've brought up a time or 15 here, which is most retail investors don't actually buy corporate bonds.
Right.
Because it's really hard to do. They indirectly buy bonds through bond funds, which is a very different set of circumstances.
Well, that's just an asset allocation play. That has nothing to do with the yield.
Yep. Correct. Because you can buy bond funds focused on the yield. You can do that, but not that many people do. The thing that really differentiates insurance companies and their way of approaching bonds is the fact that they are, in essence, market makers for a lot of debt issuances.
Mm-hmm.
And the way in which they are flexing that muscle is shifting. And what a lot of insurance companies are doing these days is going directly to the institutions that need to borrow money and negotiating a debt issuance privately with them in order to get the terms that they want. And
so these aren't bonds that are sold on the... These aren't even bonds that you and I could go to any marketplace and buy.
Nope. If we had the best access to the bond market and we understood how to actually trade bonds like a bona fide bond trader, we still wouldn't have access to the debt issuances that these insurance companies are setting up.
Right.
Because they are privately, directly negotiated deals.
Right.
And that gives them several advantages. One, higher yield. Two, better provisions to protect the downside for the insurance company. Right. Covenants is usually the technical finance term that we would use. That gives the insurance company a serious advantage when it comes to what they can achieve investment result-wise in bonds that you as a retail investor or you as the world's smartest CFP will never, ever match.
Right.
And for what it's worth, and this is an episode about whole life insurance, but they do the same thing with options when it comes to indexing products. Right. Which is why we've always giggled a little bit to people who look at options pricing on the open market for retail investors and say, well, how are they creating these cap rates? My math doesn't work out that way. Because they're not paying what you pay to do that. The number of private deals or the percentage of private issued debt that insurance companies have in their portfolio is growing close to about 50% of their total bond holdings.
Yeah, that blew me away.
It's a big number.
Mm-hmm.
And on average, they're able to achieve a 25 to 50 basis point bump in yield by taking this avenue.
Over publicly traded bonds.
Correct.
Gotcha.
Yep. And you may look at that and think, oh, well, that doesn't seem like a huge difference. I'll remind you, we're talking about billions and billions of dollars.
Or trillions. I mean, if you look at the whole...
Oh, yeah, trillions in terms of the entire industry, yes.
Yeah.
But on an individual company basis.
Yeah.
Like, I ran through the numbers here, and look, this is speculative on my part, but if we assume roughly that it's 45.9% of the bond holding, I just grabbed MassMutual's numbers from most recent statutory filing, and I just used 35 basis points as the bump, not 50. That's like $453 million additional dollars that would be collected. That's 18% of the total dividend payout.
Yeah.
That's meaningful money.
Yeah.
It's very, very meaningful money. And the other interesting thing here is that the insurance company has a corner on this market because there aren't other institutions that have the capability to negotiate these terms in the same way. The thing that makes the insurance industry highly, highly coveted as a lender is the fact that it has no desire to trade the debt.
Right.
So it is very, very patient when it comes to the long, gradual collection of interest payments.
Yep.
The odds of getting a phone call from the insurance company, in this case the lender, and finding out that they want to call the debt because conditions have changed and they'd like to close the deal. So we want our money back. That's not going to happen. And that gives the insurance industry a lot of leverage when it comes to negotiating up yield.
As long as those interest payments keep coming, you're not going to hear anything.
Nope. You're not. And this has really turned the insurance industry into a massive lender.
Yeah.
For company investment financing.
Right.
And it has long been a practice. It's grown significantly in terms of how many of these private issuances get done now. But it is of intense interest to a lot of insurance companies. And when major tech companies talk about borrowing billions and billions and billions of dollars to build out data centers, there are heavy breathing noises that we can hear emanating from Milwaukee and Springfield, Massachusetts.
Yep. And you got to figure, I mean, this is all speculation on my part, but sort of understanding the ins and outs and workings of public markets. And early in my career, I worked down the hall from people who put together bond deals. No, that was on the public finance side, so municipals, but it's not a small thing. It's a big deal, and it takes a long time to put that together. You got to figure, again, speculation on my part, negotiating with one private party to do a deal is a whole lot faster to come to terms, that everyone can agree with. I'll have my attorney talk to your attorney, we'll work it out, sort of thing. Obviously, it's more involved than that, but you get my point. And one of the things that you and I have said for a long time with insurance companies and their general accounts, many people could look at, you could all look at statutory filings and that we have access to, and anyone, if you want to pay for them, right, can have access to them.
Yep.
That will show you things like the net investment yield that a general account in an insurance company is able to generate. And people will look at those numbers and go, I did better than that in my rollover IRA last year. And it's like, yeah, you probably did, but you didn't have to invest $300 billion.
You mean you weren't going to buy all the shares of SPY outstanding with your $200,000?
Right. The point I'm making is that as these companies get larger and larger and their general accounts or reservoirs or pools of capital, however you want to characterize it, as they get larger, moving the needle at all is very difficult for them.
Yep.
Because there's just not, they may find something that's really good opportunity, but there's only $20 million available or something, that seems large to us, obviously. But to them, if you think about trying to affect, the yield by a tenth of a point on a $100 billion pool of assets, it's going to take a lot.
Well, that's been one of the frustrations aired when it comes to Northwestern and their dividend. Yeah. It's big. $9 billion is not a small number.
No.
They also have a lot of policyholders and they manage hundreds of billions of dollars.
Right.
And the reason it's not larger is because if they find an opportunity and they invest in it, it's never going to be all of the money that they have. On the one hand, they would argue it would be irresponsible to do that. But on the other, there's just not enough different options to constantly buy up new investments and move the yield. Yep. So it's hard. It's hard to do. Mm-hmm. So any increase is noteworthy.
Yep. Right.
But the other piece here that we shouldn't overlook, and lots of people do because it's really easy, is the impactful diversification that this creates.
Mm-hmm. Mm-hmm.
Because when you're talking about managing assets of this size and the difficulty in finding yields that meaningfully increase overall net yield, you're also talking about asset pools that are extraordinarily diverse. And that, going back to your individual who says, well, I did better than that in my rollover IRA. Yeah, but your diversification is squat compared to theirs.
Right.
Because tariffs, no tariffs, your account goes all over the place.
Right.
Do you know what's happened to the general accounts at insurance companies when all that happens? Nothing.
Right. I would think very much. I mean, it doesn't matter. Well, so, I mean, if you think about the private part of it, the private credit aspect of it, mm-hmm. there is no market. So
there isn't.
So the value is whatever it is. I mean, there
isn't, but there's also just a mind-boggling expansion of diversification in that context.
Well, there was a stat that JP Morgan published that said something like that. I was trying to find it.
Reduces volatility by 7 points.
Yeah,
and increases return by 12.
And that's just with a 5% allocation to private credit.
Yep. So we're able to increase meaningfully the yield we get and also decrease meaningfully the volatility of the portfolio.
Right. And that's the whole game.
Mm-hmm.
I mean, that's sort of a meta concept because that's what insurance companies do in general. Yeah. But they do that inside of themselves as well. So,
But think for a second about sector risk for a second. So like I mentioned data centers because that's kind of the hot topic that everybody's thinking about right now. But for insurance companies, there are way broader and way more boring things that need to get financed.
Sure.
And they do it. There are small businesses all over the place that are never going to do a public debt issuance because they're not large enough companies.
Right.
But insurance companies will lend to them all day long. And a lot of these companies, you may think, well, they're small. That's risky. A lot of those companies are flush with cash.
Yeah.
And have tons of cash flow. Insurance companies wouldn't be willing to lend to them if they didn't.
Right.
I assure you, something I have learned as I've gone through adulthood. There is a business somewhere probably within 10 miles of all of us that is worth many hundreds of millions of dollars that no one's ever heard of.
It doesn't even have a sign.
Mm-hmm.
What's the example of the label company or something?
The label
like
company here in the town that I live in. I live in a town of like 1,100 people.
Yeah.
And there is a label company that I'm very envious of because I know it makes money. It's been around for a long, long time and it has zero web presence.
Right.
I actually learned this lesson like 6 years ago when a company, like a 35-minute drive from me, sold to I think it was a Swedish company that was in the same business. They basically manufactured medical plastics supplies.
Yeah, Right.
This little tiny company no one had ever heard of sold for like $250 million.
I read a story earlier today about this guy who had a small manufacturing operation and been around for like 30 years and sold for like $40 million. Mm-hmm. And the commentary was he didn't even have any sales. Like he'd never done any like outbound sales strategy, you know. That was what the whole point of the thing was. I'm reading between the lines going, he didn't need to do any sales because like he had a product that people wanted and he was really good at making it, and that's all the sales he needed. So yeah. And those are everywhere. Yeah. Those are everywhere.
They are. Now we're in the bonus.
They're usually in nondescript metal buildings and industrial parks. Yep. I mean,
the label company I thought didn't exist because the sign has been falling apart since I moved here.
Sort of ironic that a sign company has. Yeah.
Well, it's like the contractor who lives in the torn apart house.
But it's not like anyone's stopping in to buy labels.
No.
So
no, because they only do industrial business. Yeah, it's that stuff exists, and those people borrow money, and they are great customers for that kind of lender because they pay very consistently because they have the cash flow to do it.
Yeah.
And it makes perfect sense. Like we need to borrow money, so as long as we can borrow at this rate, our expected return on this is that number times whatever, and it's fine. We can carry that loan to term, doesn't bother us at all, and we're going to make the money we need to make. Mm-hmm. And when the business has been around for 35 years, it's pretty at that point sure that if we borrow this money, we're going to be able to do this thing, and it's all going to work out.
Yep. Exactly. Oh God, we're deep into the bonus round.
We are, but that's okay. That's okay. What's the risk? That's the big question that we also need to address. There is some grumbling about the fact that private issue debt is hard to rate from a credit quality standpoint, and that's a reasonable criticism.
Yeah. If you actually care about rating agencies. Yeah.
Well, rating agencies have made mistakes in the past on public debt. So, yeah. The one thing that I do want to be clear about is that this is not the sort of packaged subprime stuff that we heard a lot about in 2008.
Right.
That's not what we mean by private debt issuances. The other risk that does face the insurance industry, and to what degree it'll meaningfully impact dividends, is the fact that at one time, a lot of insurance companies were very heavily invested in commercial real estate,
yeah,
and specifically office-based commercial real estate.
Yep.
Which I don't know if you're unaware, not really a hot commodity these days.
Seems to be a liability in a lot of cases.
Mm-hmm. But here again,
we've seen several insurance companies divest themselves of their Class A office space.
They have. But here again, we see some of the patience of the insurance industries being a benefit, because some of those loans need to be renegotiated.
Yeah.
And a lot of those office spaces are having a difficult time coming up with the cash flow because occupancy's on the low side.
Yep.
But for the insurance industry, they can renegotiate, and they may not get the deal that they ideally want, but as long as the yield is still there, there's a certain amount of patience that they can practice that will stop this from being a total 100% write down.
Sure, of course. And of course there's going to be some that go bad, but it's such a small percentage. That happens in everything, in every industry.
So huge amounts of diversification. And I really cannot overstate that when it comes to this strategy. Interest rates going up absolutely influence dividends, but there is more going on than meets the eye in a really, really good way.
Yeah.
And it makes for the safety profile that we have always talked about and advocated as the key reason why whole life insurance is a worthwhile consideration for a safety component to your portfolio.
Yeah. That is very true.
And now that we have robbed 10 minutes of your time, that's it for me.
That's all you have to say about that?
Yep.
All right.
So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.